Hello everybody and welcome to the next in a series of Blackwell Global Trading webinars. Today we're going to talk about a couple of topics that are perhaps maybe a little misunderstood or misrepresented within trading. What we're going to be talking about is correlation versus co-integration. I appreciate that some of you who may be new to trading may not have heard these particular terms or understand their implications within trading, and I hope that by the end of this session you will be far better educated upon it. For those who don't know me, my name's Paul Wallace. I'll be the presenter here, and we'll happily take any questions that you have. You should be able to see them there on the chat box, and if you just type in your questions, and either myself or one of the Blackwell Global representatives will be able to happily answer those particular questions. Before I dig into the, let's say, the meat of the presentation, what we're going to start with, as always, is with a quick risk disclaimer. Forex and CFDs are leveraged products and involve a high level of risk and can result in the loss of all your invested capital. Therefore, Forex and CFDs may not be suitable for all investors. You should not risk more than you are prepared to lose. Before deciding to trade, please ensure you understand the risks involved and take into account your level of experience. Seek independent advice if necessary. The information in this webinar is not considered as investment advice or investment recommendation for a purchase or sale of any foreign currency, CFD, precious metals, or any other products offered by Blackwell Global. So, correlation versus co-integration. Well, I suppose if you're new to trading, it would help if I talk through a very brief definition of both of those particular items, giving you a little bit of insight into what they are and how they impact us as traders. I'm actually going to be talking about the sort of, let's say, the bigger picture, which is actually about pairs trading. Some of you here tonight may be aware of that. Some of you may even have experience of it. For some of you, it may be completely new concept, and hopefully I'll be able to explain that and show you a few examples. Then we'll talk more about correlations and about the impact they have on financial markets, and also about how you can utilize them as a trader to help guide your trading decisions. Not surprisingly, we'll talk a little bit about co-integration and how that differs from correlation, and I'll give you a few examples of how you look at particular pairs that you're able to watch and utilize for both correlation and co-integration purposes. At the very base understanding, correlation and co-integration are two regression-based concepts. So if you're a new trader, you might be trying to work out what does that actually mean. Well, very often you'll hear traders talk about a reversion to mean, which is really the idea underpinning regression-based concept. Namely, as an instrument has moved a certain number of deviations away from its mean value, then the likelihood is that the price will return to that mean value. For traders who have the opportunity to work and understand that concept, well, then that can actually provide very useful and very profitable trading ideas. The thing about both correlation, co-integration, mean reversion, regression, and pairs trading is that they're commonly misused by the trading community. You'll very often find either the understandings or the definitions are incorrect, or the way that new traders try to utilize them within their own trading is poorly understood and poorly represented. What I would say about correlation and co-integration is that they are interrelated. And what we're interrelated in means that they are used to calculate the relationships between two or more products over a specific time period. The good thing about pairs trading, correlation, co-integration, regression, mean reversion is that they can be used on commodities, forex, indices, and stock prices, and even more instruments, as I will demonstrate later in this particular presentation. So, what I just want you to understand from that is that they are from a similar concept based around regression, a reversion to the mean. And that's what I'd like you just to hold in your mind as we go through the remainder of the presentation. When I look at pairs trading is a market neutral trading strategy. What does that actually mean? What it actually means for most traders is that pairs trading in a market neutral environment is that regardless of the direction, the trader should be able to profit from it. The direction isn't necessarily important. The trader's strategy should be able to generate positive returns from that particular environment. In terms of the actual technicality of what pairs trading involves, well, here we normally talk about matching two particular instruments. What we're looking is matching a long position with a short position in a pair of highly correlated instruments. So, what we'll be looking to have is to buy one particular instrument while selling another instrument. As I mentioned in the previous slide, pairs trading can be employed across all manner of instruments and vehicles, so people will use it in stocks, indices, currencies, commodities, and they'll also even use it in trading vehicles like exchange traded funds, which you may hear called ETFs, and they can actually even use options. When we're looking at pairs trading, what is a trader actually looking for? What are they waiting for? Well, what they're waiting for is a weakness in the correlation. So what we're expecting is that when we're looking at effectively two correlated instruments, what we're expecting is that once price starts to move a set number of deviations away from the mean value, that is when traders who are pairs traders start to become interested. What they'll be looking to do is to buy the underperforming instrument, whether that be a currency, whether that be a share, whether that be an index, and they'll be looking to sell the overperforming instrument. So, for example, you may be a trader in the pharmaceutical sector. That might be your particular sector of interest, and what you might find is that, in this particular sector, the underperforming stock is something like AstraZeneca. AstraZeneca has underperformed the rest of the sector and the rest of the index, and so what we'd be looking to do is to basically buy the underperforming. And at the same time, we may also be watching, let's say, GSK, GlaxoSmithKline Beecham, which may be the overperformer within that both that sector and within the indices itself. And what we'd be looking to do is to sell the overperformer. So we're looking to buy the underperforming and looking to sell the overperforming. As those prices return to the normal, as they regress and revert to the mean, that is when we would look to close that position. And the profit that a pairs trader derives is from the difference in the price change between the two instruments. What may happen is that you may have one side of the trade is profitable, the other side is either a very small loss or a small profit or is stable, and occasionally you'll do well where both sides of the trade are perform well in profit, and that provides you with a very nice trade setup. But realistically, what we're looking at and understanding is in terms of pairs trading, we are looking to two correlated instruments. We're looking to buy the underperformer and looking to sell the overperformer. So where did pairs trading come into prominence? Well, from my understanding, it started out in the 1980s. I think I was understanding it was sort of at Morgan Stanley on Wall Street where this began, and this actually began the sort of let's say in some respects the rise of the quants within trading floors, firstly in banks and then in funds. It actually fell out of favour, after a few years of doing exceptionally well. But what's happened over the last few years is, firstly, with the advent of the internet, and perhaps more importantly with improvements in trading technology, the ability for the quants or for traders to actually understand and to measure the difference in particularly correlated instruments has improved exponentially. And with that capability, well, now pairs trading and the various forms of it is now back in interest. Sometimes you may hear it under a cover-all name of statistical arbitrage or stat arb, you'll hear. But invariably what it is that trading technology has allowed traders and the quants of this world to actually do some fantastically in-depth analysis of particular pairs and be able to use that to develop models which provide profitable trading opportunities. So, as I said, now we're able to use technology to take into account fundamentals of a particular instrument, probabilities by actually using things like game theory, a definite understanding of statistics, and able to use elements of technical analysis. So as I said, sometimes you'll hear this all under a sort of a catch-all phrase of stat arb or statistical arbitrage. But what I really want you to understand is you can break pair trading and pairs trading down into three simple ideas. Pairs traders are looking to identify the relationships between two instruments in order to determine the probability of their next direction, and then they're going to execute those trades based on the data presented. Very, very simple understanding. Understand the relationship between the two instruments, determine a direction, and then execute trades based on the data that is presented. And that's actually what I want you to try and understand. So, if we have a little look at correlation first, correlation focuses on the relationship between two instruments, and in particular, how they move in relation to each other. I'm going to use examples within the FX markets, the foreign exchange markets, and so here you can show how currency correlation is the statistical measure of whether two currency pairs move in the same, opposite, or totally random direction. And it's my belief that all professional traders need to understand these correlations and, at a deeper level, the sort of relationship between those currency pairs. As I said, it's important to understand, do those currency pairs move in the same, the opposite, or the totally random direction? And as I'll come on to in a few slides down the flow, we'll understand why that becomes important. For the moment, I just need you to understand that when we're looking at things like currency correlation, but realistically correlations across any instrument, it's understanding whether those particular instruments move in the same, opposite, or totally random direction. Because by understanding that relationship, we're able to utilize that to help us make better informed trading decisions. So when we look at, in this particular example, currency correlations, we can start to understand the statistical measures employed. You'll very often hear when we talk about correlations in trading that people are understanding the correlation coefficient. You'll quite often hear that term displayed. And what it is the correlation coefficient ranges between -1 to +1. It's a range. So within that, when you have a perfect positive correlation, that is a correlation coefficient of +1. And what that's implying is that the two currency pairs, or whatever instruments that you're looking at, they will move in the same direction 100% of the time. Not surprisingly, if you have a perfect negative correlation, a coefficient of -1, it means that the currency pair will move in the opposite direction 100% of the time. And if the correlation is 0 or near to 0, it means the movements between two currency pairs is said to have 0 or no correlation. They are completely independent in their movement. So, just remember, when we have a positive correlation up towards +1, that means those currency pairs move in the same direction most of the time. The flip side is a negative correlation where you have a coefficient of a negative number. -1 means that they will move in the opposite direction. And when the number is near 0, that means there is literally no correlation and they are completely independent in their movement. So how does that actually look? What does that actually mean to a trader? Well, what we have here is we have a matrix here of correlations within the euro dollar. So you can see probably across the top of the box there we have a wide range of the major currency pairs. So we've got euro dollar and its correlations against dollar yen, dollar Swiss franc, pound against dollar, dollar against the CAD, the Aussie dollar against the US dollar, the Kiwi dollar against the US dollar, the euro against the yen, and the euro against the sterling pound. And down the left axis we can see the actual time scale. So what are the correlations like over the last week, last month, 3 months, 6 months, and a year. So if we can just look at these numbers, some of you may already be able to pick out some of the relationships. Some of you may be able to look at it and not truly understand it. So why don't we talk through just a few of the prominent ones. So what leaps out of the chart at me is when I look at over a 1 week period, I see that the dollar Swiss franc has a perfect negative correlation with the euro dollar. So remember what I just said on the previous slide. Okay, if there's a perfect negative correlation, that means that they will move in the opposite direction 100% of the time. Whereas if I look at the dollar yen here over a week, well, we have a negative correlation of 0.23. So the correlation isn't, very strong whatsoever. We can see that the US dollar against the Canadian dollar, that's negative 0.98. So there is a really good negative correlation there between the euro dollar and the US dollar Canadian dollar. If I look at the Australian dollar against the US dollar, well, now we're looking at just under a perfect positive correlation. Namely that what we'd expect is over the last week, the euro dollar and the Aussie against the dollar have moved in perfect correlation. They've moved in the same direction at the same time. So, as you can maybe understand, the longer that you look back at these correlations, the stronger they can have. And so when we look back at over periods of 6 months to a year, that starts to give us some real interesting insight into the relationships between those major currency pairs. So if I look at here over a year's time scale, once again we can see that the dollar Swiss franc has had just literally is a minus 0.98 negative correlation. So they almost constantly move in the opposite direction together. Whereas if I look at the Australian dollar against the US dollar, and the New Zealand dollar against the US dollar, we can see that they move in an almost perfect positive correlation, that they will move in the same direction. Some of you may already be able to understand and work out why that may be, but we'll talk about that when we look at the charts in the next couple of slides. One of the things that is also interesting is we can look at over the last year, the euro sterling has had a 0.02 correlation with the euro dollar. So effectively, there is no correlation there between euro sterling and euro dollar over the last year. They are effectively operate independently of themselves. So hopefully, if you've never really looked at one of these charts before or never really understood the stat measures that are implied, you can start to quickly build up a picture of how that information might be useful to you as a trader. There are ways and means to interpret that and utilize that to build trading ideas. Here's a chart I sort of just pulled up from just before. So what we have here is two charts of two FX pairs. On the left I have the euro against the US dollar, and on the right I have the dollar against the Swiss franc. This is just literally just pulled up and put in here. They're 4-hour charts, so if you're completely new to trading, that means that every candlestick that you see there is effectively 4 hours of data. A white candle is a bullish candle, a black candle is a bearish candle. So you might be able to remember from the slide previously that we had an almost perfect negative correlation between the euro dollar and the dollar Swiss franc, namely meaning that they move in the opposite direction almost 100% of the time. So let's have a look at the euro dollar. You can see here from the bottom left, euro dollar has been in a bit of an uptrend, and as it's been in an uptrend, that uptrend accelerated away until it became a little bit overextended. Then it reverted back to its mean and continued on with its uptrend. If we switch to the other chart and I look at the dollar against the Swiss franc, well, the dollar and the Swiss franc was, sort of grinding in a small downtrend before it accelerated away and fell quite significantly and became overextended. It then effectively reverted to its mean and then continued on in its downtrend. Hopefully, you can see that statistical measure we just looked at before in terms of the almost perfect negative correlation displays itself here in the charts. As the euro dollar goes up, the dollar Swiss franc goes down. This is a very simple currency correlation, but it gives you a very, very good, clear insight into how these correlations work and how traders can start to utilize these to build trading ideas around those correlations. So, why are those correlations useful? How do traders use them? Well, one of the ways you can do it is to eliminate counterproductive trading. What does that actually mean? Well, if we just look back at those two previous charts we had on before, you had euro dollar going up, going long, dollar Swiss franc going south. Well, if you buy the euro dollar and sell the dollar Swiss franc, effectively what you have there is you have a position that is, in the euro dollar, you're effectively long the euro, short the US dollar. And if you're short dollar Swiss franc, that means once again you are short the US dollar and you are effectively long the Swiss franc. So in many ways you're actually taking the same trade, namely that you are short the US dollar. So for some traders that actually is for some traders that is an attractive way to trading. For others that would be counterproductive. You're effectively doubling up and have two trades, namely two short US dollar trades. Some traders will use it in an effort to leverage their profits. Perhaps they will take both those trades. Perhaps they will look to understand which of those correlated currency pairs moves the furthest, which of the ones has the largest average true range, and utilize that to be able to try and run their trade longer. Some traders would actually like to use it to diversify risk. We just talked about maybe having too many positions in one currency. So we looked at that statistical measure that the euro against the dollar has a negative, perfect correlation against the dollar Swiss franc, but actually has no correlation with the euro sterling. So invariably it might be, if you're looking to diversify your risk, well then invariably your trades might be on euro against dollar, but also on euro and sterling, because you know that they move independently. Some traders will use that in an effort to hedge the risk that they may have within a large and, let's say, widespread portfolio. One of the other things that, let's say, shorter term traders are keen and interested in understanding correlations for is that it can help them confirm a breakout, or even better, avoid a fake out. Within FX trading, there are an awful lot of false breakouts, and if you don't see a correlation across, let's say, the particular currencies that you're trading, well then that might give you a sort of a heads up that the breakout that you're watching on one currency pair may actually be a false breakout. It may be what we'd call a fake out. And that might just give you an edge whether to take that particular trade or not. So there's lots of ways you can see how and why traders would use them to effectively help them make better trading decisions. So remember what I said a good few slides back, namely that pairs traders are attempting to identify relationships between the two instruments, determine a direction of travel for that relationship, and execute trades based on the data presented. So hopefully you just had a little look there at the euro dollar and the dollar Swiss franc, and you're able to see how you can identify the relationship between the two instruments, determine the direction of their relationship, and then you would look at ways to execute trades. And that's something we'll come on to in a couple of slides. So when they start to build ideas around the currency correlations they see, pairs traders are looking to seek instruments whose prices tend to move together. what they're looking for is a good correlation coefficient. And as a rule of thumb, correlations above 0.8, they are often used as a benchmark for pairs traders. They're always looking to see where there is a good correlation above 0.8. Why is that? Well, if the two instruments are not correlated, if there is no correlation, a little bit like the euro dollar or the euro sterling that we saw a few slides back, well, any divergence or convergence between those particular trading pairs have little or no meaning because they operate pretty much completely independently. Remember what I was just saying on the last slide, that when we see instruments that are particularly correlated or even negatively correlated, they can help to do things like to confirm breakouts and avoid fakeouts. And so correlations in particular currency pairs above 0.8 will help a trader utilize that data, will give them confidence to be able to make decisions based upon what those statistical measures are showing them. So I thought I'd actually add in just a couple of slides here, just to give you a little understanding of how those kind of correlations can work. How do we see them in the present markets? Well, here we have on one of these charts is we've got a correlation between the pound, okay, in particular pound against the dollar here, against the actual equity indices, the UK 100, the FTSE 100. So a lot of that has been driven by the effect of Brexit, and what we saw was that leading up to the decision and afterwards, we saw a weakening in the pound sterling. We saw people were effectively short pound sterling across the board, and hopefully on the left there you can see that we saw a great move down in the pound against dollar. But that had an effect, an impact on a relationship with the FTSE 100. So as the sterling has weakened, the FTSE 100 has actually risen. And why is that? Well, there is a relationship there. They're based on a purely simple fundamental one, namely that the FTSE 100 is now made up mostly of international companies who actually generate and report their profits mostly in dollars and euros, not just the pound sterling. So invariably, as pound sterling has weakened, the actual profits that these FTSE 100 companies can represent or they will report will actually be increased. So invariably that had an impact on how attractive those companies were. So as sterling has fallen, the FTSE 100 has risen. So there is there's a negative correlation there, but it has been a particularly strong one over the last year or so. And what we've started to see is, as we look at a couple of the other charts, that kind of correlation or that relationship, okay, flows through time and time again. So here's another example, and this is a kind of an interesting example of how QE, which has realistically been part of our, let's say, our trading experience over the last 6 or 7 years, how that quantitative easing has had an impact upon correlations between, in this particular case, once again, a currency and the major index. So what we see here on the left is a daily chart of the euro against the dollar. And hopefully you can see that that is a very nice and clear uptrend that we have been in for the vast majority of the last sort of 3 to 6 months, as the euro has strengthened because of fundamental factors, namely that the populism has fallen away. We had the sort of success of Macron in his French election, which basically put the sort of populist vote to bed for the short while. That basically re-engage confidence in the euro area and the eurozone, so invariably people were buying euros. But that has an impact, okay, and that has an impact on the relationship with the major index of that eurozone area, the DAX, which is what we have here on the daily chart. So as the euro has got stronger, that basically means that German companies have struggled in terms of their profits. Their profit margins will be decreased. So there is that balance, that relationship between both the strength of the euro and the particular strength of the German DAX. Now, there are other factors that would have an impact, but as a general rule, what we have seen is a correlation between once QE has either been moved or there's been other political moves within a particular zone or particular currency, what we would see is an impact on the major currency and actually on the particular index that is linked to it. And there is normally a negative correlation between those, and that has provided an opportunity for traders to sort of to take opportunity of that. So we've had a look at the overall pairs trading. We've had a look at elements of correlation. So now let's have a talk about co-integration. What is it? How does that actually help us as traders? How can we utilize it? Once again, co-integration is essentially a reversion to mean tactic. As an instrument starts to overextend by certain numbers of deviations, that provides us an opportunity to take a trade in the direction of a suspected reversion to the mean. Now, when we looked at correlation, we're looking at correlation meaning that individual prices move together. We saw that effectively pairs traders are particularly interested in instruments that have a correlation coefficient of above 0.8. The difference is co-integration is looking at a longer term relationship, and it's more looking at being based on the co-movement of prices. And I'll explain that in a little bit more depth as we go on. In particular, we're looking at where they move together within a certain range or a certain spreads. What I want you to think of it is the relationship is more like those particular instruments are tethered. And I will explain that using a rather a simpler analogy in a couple of slides' time. What we're looking at is co-integration refers to the equilibrium relationship between sets of time series. So what this might be as an example is the stock market index and its related futures contract. Although the two prices may walk relatively randomly over a brief period of time, let's say over a few hours or over the day, ultimately they will return to equilibrium and the deviations will be stationary. And it's actually that relationship, of the deviations that starts to become of interest for co-integration based trading. That co-integration analyzes the movements in prices and identifies the degree to which two values are sensitive to the same mean or average price over a given period of time. Doesn't really say anything about the direction that those pairs will move. Co-integration only measures whether or not the distance between them remains stable over time. And it is that distance between them that starts to become of interest to traders. So, here's a little bit of let's say a different analogy to try and help and explain and maybe sort of pitch co-integration in a simpler way. I want you to think about being this person who is walking dogs on a leash. Okay, so when you take a dog for a walk, the dog is on a leash and may wander randomly over brief periods of time, depending upon the length of the leash. However, the dog and the dog walker, they will always be close together and they'll always be on the same pathway. They'll always be going on towards, let's say, the same destination. The distance between them is fairly predictable, and so they are deemed to be co-integrated. Okay, so whenever you take a walk around the park from now on, whenever you see somebody out walking their dog on a leash, you can understand that in terms of trading, it's looking at instruments, whether it be two or more, that are heading in the same direction, but they may wander randomly over brief periods of time, but they're headed in the same direction, and so they are co-integrated. As opposed to a dog who is off its leash, where if you'll ever see that, they'll run left, right, and centre. They are not co-integrated. So, Here's a few other examples of co-integration from where we can see it in the real world. Okay, so in terms of income and spending and real world economics are deemed to be co-integrated. Okay, they are heading in the same direction. Right, there is a relationship there between income and spending. As income goes up, so does spending. As income goes down, so does spending. They are deemed to be co-integrated. There's also a relationship that's deemed between the, let's say, the harshness of criminal laws and the size of prison populations. So invariably, where we find a country where the criminal laws at the time are enormously harsh, well, so is the size of the prison population. They are deemed to be co-integrated. They may have little random brief periods apart, but they are headed in the same direction. They are on the same pathway. Here's an example from FX trading. Okay, here's a good example is the euro dollar and the pound against the dollar. The euro dollar is the largest, most liquid traded contract in the world. All right, and invariably where the euro dollar is going, other dollar denominated pairs will follow. So what you might see is that the pound against dollar is like the dog on the leash. Occasionally it'll wander off from time to time, but overall it's going on the same pathway as the euro dollar. And this has been interesting for us presently as traders, based upon what we've seen over the last year with Brexit and the rise of the euro. So here we have on the left, I've got the euro against the dollar on the monthly chart, the pound against dollar on the monthly charts here. Okay, so hopefully you can see there's been an element of correlation, but actually what we're more interested in is that there has been co-integration there. How do we define it? Well, because they have been going in the same path based upon the relationship of the dollar and relationship of the euro. And whilst the pound against dollar, even after Brexit, may have wandered off, okay, briefly, independently, the reality is that they are tethered. Pound against dollar and euro against dollar is tethered. The pound against dollar is like the dog. The euro against the dollar is like the owner, okay? And invariably the dog might wander off a little bit, but where the euro dollar, where the dog walk is going, that is invariably where the pound against the dollar will also tend to head. So that's another way you can think about it in terms of FX markets. If we look at commodities trading, well then a good example is gold and silver. All right, we find that gold and silver, they may track a common average value. They may trade in opposite directions from day to day. All right, but at some point in the future, they should revert back towards that average, and hence they are co-integrated. All right. So hedge funds will commonly use this sort of formula to program statistical arbitrage models to identify pairs or instruments to trade. So silver may wander off from time to time, but ultimately what's happening is it's going on the same pathway as where gold is. So here we have on the left, what I've done is put gold chart up, and on the right we've got the silver chart up. All right. So we can see maybe there is an element of correlation in the way they move, but there are periods where the relationship is a little bit different. Okay, we can see silver there at the start of July had a big drop. Okay, it pushed a little bit further away than gold did. But the reality is, where gold is going based upon supply and demand within the commodities market, well then where the pathway that gold is heading on, silver and you'll find other commodities will align with that. And there might be all sorts of elements that that feed into that. It's not just purely technical analysis, as we covered earlier. It can be down to fundamentals. It can be down to statistics. It can be down to probability. It can be down in the terms of things like Brexit. It can be political measures that have an impact upon those relationships. But it's about understanding how close is that co-integration relationship, and when it starts to differ, that is when it provides that opportunity for a mean reversion trading opportunity. So if we want to have another one, look at it in indices. Okay, if you're a trader of indices, a good example is the German DAX and the UK FTSE. The reality is that, within Europe, okay, the DAX is the major traded indices instrument, and so the majority of the European indices will track what the DAX is doing. The FTSE may wander off from time to time, as we've maybe seen as element recently, okay, with regards to Brexit, but ultimately they will be going on the same pathway. So what I've got here on this chart, on the left we've got the DAX on the weekly chart. On the right we've got the FTSE on the FTSE 100 on the weekly chart as well. We talked a little bit about how the FTSE 100 has done well out of the let's say the negative correlation with the pound sterling. But what we also have is that there's an element of it co-integrated with the DAX. And it has normally been a pretty steady relationship. And so when that relationship starts to change, when those ranges and spreads start to drift apart to the edges, that is when opportunities start to arise. So perhaps you can see that over the last few months, actually what's happened is the sort of the FTSE has gone sideways, whereas the DAX has actually started to dip. And so as they are operating independently but going into this, let's say, to the same endpoint, and it is those relationships between them that starts to offer us up the opportunity to build mean reversion trade opportunities on that element of co-integration. So the thing about co-integration trading is that it is a market neutral strategy. It's not necessarily about the specific direction of the market, but understanding the sort of the pathway and the end point. And in particular, it lends itself to longer term analysis. Okay, this is where we're looking at things that may happen over many months to many years. The longer is actually the better, because the longer the data we look at, the more stability there is in the sort of the ranges and the particular spreads, because it's when they change and when those relationships break down or drift away, that is when the trades the trade setups arise. What that does do for traders, whether you be at a bank or a fund or a private trader, is it lends itself to a mechanical trading strategy that is based upon reversion to the mean. And you will find that an awful lot of both banks and funds will run these stat arb trading strategies based around pairs trading, correlation, co-integration, understanding those relationships, looking for when those relationships have an excellent correlation, looking for those trading pairs where they are co-integrated, where there is a stability in the relationship between the instruments, and when those relationships or the stability starts to drift apart or break, recognizing that is what provides us with that particular trading opportunity. So, in conclusion, ladies and gentlemen, pairs trading is a market-neutral trading strategy. All right, we're not too worried about the direction, because it's about the relationship between the two instruments, where you're looking to seek to profit from the difference in price change between two related instruments. At its very basic pairs trading, we'll be looking to buy the underperforming instrument and sell the overperforming instrument, and as they revert to a mean, that's actually what provides us with our profit. Correlation provides the opportunity when either the instruments are highly correlated, okay, or negatively correlated. So we're looking at particular correlations above 0.8 or negative correlations beneath negative 0.8. What co-integration provides us is it provides an opportunity when two predictable prices or the predictable relationships start to drift apart. All of those can be used for what is known as mean reversion trading. We're looking to take an opportunity once, whether it be the price or the relationship has drifted apart by X number of standard deviations, then we know that there is a good opportunity for price to revert to its mean value. And that is what provides us with our trading opportunity. So there you go, ladies and gentlemen. I hope you found that useful. I hope if you're new to trading, that's given you just a little bit of insight to both pairs trading, correlation and co-integration trading. I'll happily take any questions that you have. Also, if you're watching this on demand later, well then invariably, be sure to get in touch with your Blackwell Global account representative, and they'll be very, very happy to answer any of your particular questions. We have our account representatives here now, and if you would like to ask any questions, we'll be happy to help you as we possibly can. It just remains for me to say that it's been a pleasure to speak to you this evening, and I wish you the very best success in your own trading, and I look forward to seeing you on the next Blackwell Global Trading webinar. Trade well, and we'll speak soon. Many thanks.